After a solid year of the 60-year cycle, the 20-year cycle, and the 4-year presidential cycle, all providing strong signals, we're coming back to Gary Glover to guide us through the last couple of weeks of the year. Good morning, Gary. How are you?
Yeah, no, excellent, Chris. How you going?
Well, I'm looking back at the last 12 months and say this has been an absolutely stellar, strong performance for you, the portfolio. And for those who haven't watched, they've really missed you picking the highs, the lows, and really timing's just been insanely accurate. So when we recap those cycles, you've put together a lot of them and really picked those highs and lows. But reading your report this week, it's kind of looking like you're seeing the indices, both the Aussie and the US, have less clarity about where they may go next. What are you thinking now when you see those indices?
Yeah, no, you're bang on 100% there, Chris. I mean, I think like a lot of the cycles that I've been looking at the last year, that they've all been in alignment. So, sort of a 10-year, a 20, 60, like a lot of our seasonal 4-year, the presidential cycle, the midterm year, which is a really strong 4-year cycle. So they're all pretty strong cycles, and they've all been in alignment for the last sort of 12 to 18 months. And maybe that's one of the reasons why we've had some consistency in our moves here, because they've been all in agreement. Whereas this is the first time all year actually that there's some disparity in the views here. So I mean, the 60-year cycle, after a little December peak here, it had a little bit of a sideways shuffle, but then it continued on. It actually continued quite a bit higher there. Whereas the 20-year cycle had a really deep correction, came back right into the range, probably pulled back. I think if you remember back that 2002, we had a really deep October low, had a bit of a bounce up into deck, pulled back into February, came back almost 3/4 of the range, like almost like a big deep inverted head and shoulders, and then it sort of rallied after that. Our normal sort of midterm year cycle does cause for a bit of a choppy December, so a bit of a sideways sort of shuffle in there. So not too negative, not too positive either, but quite choppy. And our 4-year cycle, which has been sort of that's the one that the Dow's really showed that I think average gain around 21% for the final couple of months of the year, which we've already hit. So it's followed the average move here to a T. That sort of already fulfilled the average sort of marking here. So it just does suggest here we'll get a bit of a congestion there. The only thing I'll say technically there, Chris, is that I did see on a few of the markets some signs of distribution, so a little bit of selling coming in at the highs. So obviously I think the XJR, I think S&P and the Dow, there's a few of those markets did sort of show some signs of distribution. The only one really not selling there is probably the NASDAQ, which has probably had the least bounce.
Didn't go very far, did it?
Didn't go far, no, which is actually sort of a sign of weakness, really. But when I looked at this historically, this sort of sign of weakness in the past, it hasn't always resulted in like a new low. So he's going. Normally, if I saw a rally like that, it was so weak, I'd say it looks left us in a really vulnerable position. But it has overlapped. It hasn't sort of like rallied up to the last swing low and failed. It has sort of gone in an overlapping nature. And then looking at that 2002, 2004, it did something similar. It was a bit of a dull bounce, and then it was a dull congestion, and it sort of built there. So NASDAQ might just be a bit dull here for a bit. So yeah, some interesting sort of dynamics there. Look, I just think we've had a decent bounce here. That Dow's had 21%. So that being the leader here, I think that's showing us signs of that we've probably had a fair amount of movement here in the market, and that you're probably likely to get some sort of congestion there. The question I sort of think here is, are we going to get a sideways sort of shuffle here, or are we going to get something that comes back a little deeper, like the 2002, 2003 sort of low, that's been the market which I think has been a good roadmap in terms of what's happened, sort of fundamentally as well, sort of bit of a growth crunch, and then interest rates moving higher, just a lot of similarities there. So the only thing we didn't have there in 2000, 2003 was inflation at 7.5%. So that's interesting as well. We got a big week here. We've got the CPI print tonight. I think it's 12:30 tonight. Then you know, that I think consensus is around 7.3 there, Chris. It's just, you know, so people are saying 6.9. I sort of did read there a few months back there that must have been 2011, 2012. Once it got back under 6.8, that was sort of when a lot of Wall Street analysts had you know, figured that inflationary spike there had sort of topped and come off. So, yeah, 6.8, 6.9, sort of a number under there will probably get the market excited. So, yeah, but consensus is 7.3. So, look, anything under that's probably going to be taken positively. But you've got the Fed here on Thursday. Might be Thursday evening as well. That'll be the Fed rate. So at this stage, they've indicated it's going to be another 50 basis points higher, which will take them up to 4.5%. Powell's, you know, indicated that probably get to 5 there. But if the CPI print comes in a bit lower here Tuesday, they might rewind that back, and then market will get a bit more excited. So it's going to be a bit of an action-packed week here, really. Yeah, I mean, I look at some of the commodity energy prices started to cool, so you can probably see some, you know, there's probably some good reasons as to why we might see a little bit of a cooling in that CPI. But yeah, it's just sort of does take a little while to turn the wheel there. And yeah, hopefully we can see some less pressures on you know, inflationary pressures there, because that'll be good for next year. We really want to sort of see inflation dissipate here, and which will be better for equities next year. If inflation persists there, stays relatively high, just means we're going to be in a bit of a choppy market there. But yeah, that's all ahead of us. Hopefully we'll have some resolution there by the end of the week as to, you know, hopefully some signs there that inflation is subsiding. But it should be a bit of a choppy market there. I'm sort of just seeing it more of a sideways grind here, really. For I wouldn't be going short here, just because seasonally sort of second half of December is normally a bit of a buoyant period. Hasn't always been the way recently, but can be. But yeah, we've just got sort of some cycles that are sideways to sort of, you know, mildly positive, and some that are pretty negative. So I've lightened off here. I just sort of I've taken some money off the table here just to de-risk a little bit.
Well, when you're talking about de-risking, you've pulled off some strong positions that you've had, you've banked some good returns, you've edged up some stops, you've lowered some profit targets depending on what the market's done. But another aspect that you've been talking about for some time is the commodities and how that's driving, pushing and pulling the Australian market. When you have a look at the CRB index that you've put into this week's report, it seems as though it's come down, tried to have a bit of a rally, failed, fallen to a lower low, try it again, and then looks like it's setting up to fall and make another low. Is that how you're reading the CRB?
Yeah, so impulsive on the way down, sideways, you know, corrective on the way up, impulsive on the way down, sideways, corrective on the way up, and then, yeah, a little impulsive break here. So since then, we've probably seen energy prices slide a bit further this week as well. So yeah, just starting to see some of those energy markers really come off. So that's sort of good for what we want to see. So the CRB index is obviously the basket. So obviously the basket's gone up quite dramatically here since April 2020. And then we're starting to sort of see that, you know, the basket come off there. So that's a basket of all the commodities. So like, I know you'll get sort of some going up at different times there. I think when gold was going down the whole time, that was going up, and then as been coming off here, gold's been going up. So not all in the basket will, but it's just the majority, or it's the, you know, larger proportion of the basket. So we should start to see more commodities cool off here and come off here. That's what we want to sort of see there, and that will be required if we want to see some easing in those inflationary pressures. So it's just our CRB index is still showing weakness, still negative, and that's good for lower inflation. It's just interesting here that our materials index, which is our resources index, which is our basket of resources, which is aligned to, you know, commodities, that's pretty buoyant. That's been really rallying quite hard here for the last few months. So that's really different to the CRB index. So yeah, from experience, normally in materials, I find the stocks lead the actual physical, you know, index.
So what bonds lead the stocks, leads the commodities. So the commodities kind of the
Yeah,
last of the
yeah.
three.
So like before gold started to go up, you actually start to see gold stocks they normally start to rise first before the gold starts to push. It's sort of almost anticipation of gold, and that's sort of the same. When all stocks start to, if they're getting worried about oil prices, you'll see the all stocks will start to trend down before the oil price sort of starts to trend down as well. Sort of anticipate that down. So it's just interesting here. We've got material index going straight up here, almost up to a bit of a resistance level there, the old high there. So just be interesting to sort of see what happens here. I mean, some resistance there at that sort of left shoulder in terms of like a big head and shoulders pattern. I'm not a big head and shoulders person there, but definitely some resistance there. Because that's sort of come to a new marginal low there in July of this year, broken slightly below that previous low in 21. Yeah, so that often means sometimes they can go to a margin new high after doing a margin new low. Yeah, so that could go slightly higher here. So, but it's just interesting here that we've got sort of conflicting signals here regarding the commodities there. We've sort of got the commodity sort of stocks are still pretty firm, yet the commodity index has been coming off for quite a while here. So so just making the market a little tricky here, a little choppy. So I like to sort of, one of the reasons why we've had a good year, Chris, is that everything's been in alignment for me. We've had that negative pessimism at the October low, the sort of that levels where you're almost doubting yourself to buy because everyone, 9 out of 10 people are bearish there. But that's what you normally see. And then when everyone's super bullish sort of stuff, and it's it's like coal there. Everyone was sort of got to be long coal, and then at that point there where it was just like most crowded trade ever seen, and it had just cooled off. So same with energy here. Everyone was pretty bullish energy there going back like 2 or 3 months ago, and now again it was a crowded trade. It's all cooled off again. So just got to be careful these crowded trades. Definitely sort of seeing the sort of sentiment move here. What we are sort of seeing so far, Chris, is a sort of range-bound sort of sideways market. I don't want to sort of skim to that sort of CVA chart, but the CommBank chart really does sort of highlight the sort of market we've been in this year, just because we're sort of, from that sort of peak there, first peak there, we've really gone up and down in a sideways manner. For the last 12, 18 months, maybe a bit longer. So we've sort of been down to the low 90s. We've been up around that 1.8, 1.10 a few times. So we've had 1, 2, 3, 4, 5, or 6. 6 goes at the top there. We've had 1, 2, 3, 4 goes on the lower edges there as well. So that is more of a low growth sort of sideways sort of market here. So we're definitely sort of seeing that here. So that's why you sort of can't get too bullish at the peaks here and too bearish at the troughs here, because that's a typically sort of 40-70 style inflationary market there where you're getting big moves but not really going anywhere at the end of the day. So so that's, I think, until we see inflation subside substantially, to me personally, it's going to have to come well below 6.8. Then I think you've got to presume this type of market is going to take place here. We're going to see up and down, and this is sort of, if you look at the sort of, keep harping on those sort of 70s numbers there, but while that CPI was 7.5, value shares averaged 13.5% returns. So the companies have paid good dividends when they just had these big moves, and so there's a way to trade this market here. I think this sort of worst case scenario, we could still get these type of sort of moves from big stocks. So this is the fallback position at the moment, is sort of a range bound market. If we start to see CPI coming off and inflation start to ease, then we hope next year the market can really open the shoulders and get going there, and then things like your growth, tech can really get going. But I think it's too early to be there. That's the sector to not be too heavy on currently. So it'll be a bit interesting week here to sort of see how much CPI is easing. When you're seeing a lot of the markets come off quite substantially, it should be coming off. But I think if we don't see that CPI print doesn't sort of come in, a bit lower, that'll be a bit of a concern for the market. So we'll see how this week plays out.
Well, it's, as you're talking about it, if that inflation, it's all contingent upon inflation, market expectations, and all the aspects that you've talked about. But if this range-bound market remains, these are pretty big swings, 90 to 110.
Yeah.
You're getting good percentage rallies here. Are these things that we're able to trade?
Yeah, I mean, I guess to the viewers out there, I mean, there's since I was going to say October, but if you go back, you probably have to go back to sort of June, July. The bears have been have remained bearish the whole period here, and there's still a massive amount of people still in the bear camp, and this is a bear market rally. I mean, the Dow's just had a 21% rally, and there's still a heavy weight of people out there still thinking this is pretty bearish. There, I saw last night there, Chris. I think one of the traders I follow, they might have actually published them, but the short-term puts, the amount of puts being bought has gone through the roof in the last week as well. So I know you can trade more of the short-dated stuff here than ever before, but there's still a high degree of skepticism and negativity in the market there. When you see the consensus is still pretty negative, bearish there, that's normally not when you get big corrections or deep sort of stuff there. That's why I think you just got to be a bit more neutral here. I'm hoping this won't be a deep, it'll just be more of a shallow congestion there. And but looking at the NASDAQ will be the key there. That's the one where you sort of how this sort of pullback comes off the NASDAQ here. If this can just sort of hold here, if we see volumes lighten off on the way down, that's what we got to watch. Got to watch sort of trading volumes here. Got to sort of let the market tell us what it's going to do. If we start to see the market have some distribution days, some heavy selling days, then maybe something negative's ahead there. But if we start to see it pull back here and no selling in there, and it just holds up and it's more of an overlapping sort of sideways move, then that's good there. So just got to let the market tell us here what's going on here. Let the volumes and let the nature of the of the moves here. So if we see some impulsive selling, then we've got to look out. If it's more of a sideways sort of low volume sort of grind, then that's probably be sort of constructive. So so it's going to be interesting sort of week period. Me personally, I've sort of lightened off quite a bit. Just sort of try and just because I think it's still pretty tricky out there, and we've got a big week ahead here. So rather than I think normally we're seeing moves into these events, big moves up and big moves down. That's always one to worry about. But it has been choppy here recently. So just think when it gets messy and choppy there, just start playing smaller there. I think I sort of spoke on the weekend about on the Friday sort of session now about sort of the green light and the red light and maybe something like an amber sort of period. I think you've got to recognise when the market is. Market's full tilt when market's really sort of going well, and then that's when you sort of got to open the shoulders and trade accordingly. And when the market gets tricky and choppy and breakouts aren't working and it's very, very all over the place, that's when you've got to sort of ease back a bit here. And I think that's the environment where at the moment it's sort of not getting followed. It's pretty choppy. A lot of the triggers aren't sort of having big moves. It's all pretty sort of short-term orientated here, sort of swinging back and forth. So I think you just got to take the foot off there. It's funny. I talked about that on Friday, Chris. As a result of that, actually, I listened to it back and I thought, it's made me actually change one of my rules about how heavy I'm going to be invested in the market at any one time. So I think if you're in a green light sort of zone where the market's, really strong and buoyant and you're above your 50-day moving average and it's it's in a bullish cycle, then you can go to your maximums. But if it's a red light district, maybe this indices are starting to break back below 50s and 20s, or if you think you're in a bearish cycle, then you've got to temper back your limits. So basically reduce your limit size per position, maybe reduce your basically don't be fully invested then, maybe just trade a bit lighter. So I've actually introduced some rules to help myself there again, to sort of stop myself. Because I think last week I know I sort of did have one position, which was a maximum position for me, which is okay normally, but in a choppy environment, maybe that's not the way to go. Just limit the sort of size position on trade I have on. So so as traders, we've got to keep evolving, we've got to keep improving. If you can add a rule in there which is going to sort of protect you when things aren't so good and encourage you to be maybe more aggressive when things are great, then that's all good as well.
Well, they're good insights, especially as you look back on your own performance, which has been a solid year, and thinking, how can I tweak this? How can I make this better? But before we end on this week's report, you've got another one in there for BHP. So we have talked about the Australian market. You have talked about the CRB index, the impact that commodities do have on inflation, or inflation has on commodities. What do you see here at BHP coming back up, getting really close towards that $50 level again? What's that saying to you?
Yeah, look, it's interesting there. Just obviously come back to retest the high there. You can see this this sort of topping type of action there. So sometimes I can go back and go back to marginal new high. I mean, you saw with CBA there, I think it was sort of 108, and I went to sort of 110 there, and then and just recently we sort of come back there. So we didn't take out the all-time high, but we did come back out and take out the recent high. So that's like a little false break of that lower high there, which is sort of still bearish there, whereas BHP has sort of done something similar. These sort of sideways chopping environments, they can go back and retest these highs, they can get really close to them. So we were really close here. So I'm a bit worried here just because we're sort of 6 months from the previous swing high. Also the CRB index, a lot of the commodity prices are starting to break down here. The stock's gone up here. So I'm just a little hesitant here. BHP, I just think there's a chance here could pull back here. The volumes have been sort of mixed to me. They've sort of been, they haven't been super light or super heavy. They've just sort of been in between there, which is kind of more consistent with a sideways moving market rather than a bearish or a bullish type of phase here. So, just interesting here. We're pretty close to the old high there, just under there, and so I just think it's it's not uncommon to do this, I guess, to go up and retest the highs there. We saw, seeing it with CVA, the swings there, even though we've gone sideways there for all that period, we've had some big swings up and down here. So I certainly would not be buying that breakout, Chris. So I'll be scared if it broke out there, because then I'll be looking at exactly. I'll be thinking I'll go to a margin new top and then turn here, and that would be actually a more bearish scenario if you actually go to. That's like I was thinking if Combank went to 110 and broke above the high, margin new high, then that probably suggests you'll have a bigger decline all the way back down to the bottom here. Whereas sort of failing here just under the old high and then maybe just above the minor new high, that sort of suggests something a bit more messier. Maybe that's something a bit smaller there. You can go through this bigger sort of sideways orientation before you build out eventually and break out, but you don't want to see big new highs there and then failures there. That's when you normally get bigger moves on the downside. So probably for those that are positive BHP, you probably don't want to see this go to a new high here, because that was a risk of a bigger move on the downside, in my opinion. So,
well, there's some good insights on two of the biggest trading shares on the ASX, and that's probably a good wrap for this week's report. And for those who have been watching Gary and all of his reports, we do want to say a big thank you to you, Gary, for a phenomenal 2022. This has been an absolute stellar year. You really have hit the highs, the lows. The timing's just been absolutely extraordinary. I really encourage anyone to go back and have a look at those videos, especially on all the times that he's pointed on these charts, because you will see he's called it in the week or 2 weeks before it really saying, here are the turning points. But
can't promise we'll be as accurate next year, Chris. That's all I say.
If it's 50% as accurate, it's still a solid trading year. But I'll say thank you for this report, but also for the whole year. So thank you, Gary Glover from Novus Capital.
Thanks, Chris.
Cool. Well, if you want to see Gary's whole playlist throughout the year, you can click on the right-hand side where there's that playlist for all of his Tuesday reports, just like this one. And then also on the right-hand side, he's talked about the recording that we did on Friday, where he delves into that 30-30 list, looking at the strongest momentum companies on the ASX, and then also the launchpad companies. Those are getting set up to be the next leaders. He pulls apart the charts, picks out his favourite each week. That's on that report and that playlist. On the left-hand side, you can see Gary's Twitter handle. So if you want to follow him, you can click on it there. And we'll wrap up there.